Let's broaden our market conversation, though, and bring in Truist Wealth Co-Chief Investment Officer Keith Lerner and Hennion & Walsh Asset Management President and CIO Kevin Mon. Great to have you both here. Kevin, you're on set. I'm going to kick this conversation off with you. We've had a torrid run since the April lows. What do you like here? Do you stick with tech? Do you look elsewhere?
I think investors are going to have to be a lot more selective to find pockets of growth opportunities for the balance of 2025. One, because of valuations. Two, because of the torrid pace of this bull market run since early April, as you point out. But there are growth opportunities available. And where do you look for them? Well, from a momentum perspective, lean into those sectors that have been leading the market thus far, whether it's technology, whether it's aerospace and defense within the industrial sectors, or utilities. That's where all the big spending is taking place, whether it's AI infrastructure, energy infrastructure, or defense spending. And there's plenty of good companies still within those three sectors that are trading at reasonable valuations that I think could still move higher.
All right. Keith, I want to get your thoughts on this market because it does seem like we've done a 180-degree turn here in terms of sentiment if you look at some of the readings we've gotten, including this most recent survey from Bank of America.
Yeah, well, first, great to be with you all. You know, it's interesting. If you look below the surface, we do have a pretty bifurcated market. Only about 50% of stocks are above their 50 and 200-day moving averages. And what's notable is as the S&P continues to make new highs or over the last week or so, the equal index, which Mike just talked about earlier, has been moving sideways for about a month. So, listen, our perspective is you had a big run. You have the bar for positive surprises has moved up. So we think we're more in a digestion phase, likely over the next weeks and months. But we would still stick with the leaders, as mentioned earlier. We still like tech. We like communication services. And we also like utilities. But again, you know, markets are typically 2 steps forward, 1 step back. And if the market corrects somewhat in time, we think that's fine because what's really a positive, I would say, is the earnings have continued to deliver. We've seen that with the biggest revenue beat rates that we've seen in about 4 years.
Kevin, should investors be thinking about rebalancing, given all of the growth that many have seen in their portfolios? And what's the smart way to do it in this market without sort of losing momentum and selling too much of your winners?
Sure. John, anytime the market moves significantly higher or lower, they should consider rebalancing, right? Because they don't want to stray too far from their asset allocation targets that are consistent with their own tolerances for risk. One asset class that we haven't spoken about just yet are bonds. In fact, Vanguard came out this morning and suggested that bonds may outperform equities over the next decade. I don't know if that's going to be the case, but it does serve as a reminder of the potential diversification benefit of bonds. Plus, for those high-income investors who are looking for tax-free income, maybe now they want to add municipal bonds to their portfolio. But if you've been in large-cap technology, if you've been in some of these AI names that have really run higher, now may be the time, not necessarily to leave those names, but to trim your allocations and to reallocate to other areas of the market.
Keith, what about small caps? I mean, they really have not done as well as the big names here, but maybe there's a sense that they're cheaper. Is there a great reason why they're cheaper? Is there an argument to be made for dipping a toe in or averaging in to smaller caps?
Yeah, so right now, our strategy still focuses on large caps. We don't actually have a direct small cap exposure. Perhaps the reason is because there's, as far as why you want to dip a toe in is because they're so far extended. But we don't like buying relative lows, and we're making multi-decade relative lows as well. And you said, why is it? Well, part of it, if you look at the S&P 600 index, it has half the sector exposure in tech relative to large cap. And the other thing that's happening right now is there's so much money in the PE market, and these mega cap tech stocks, they're gobbling up a lot of these small cap companies before they come public. So I think structurally they've changed. It doesn't mean you can't have a balance. It doesn't mean that they won't have periods of outperformance. But structurally, we still favor the large cap space as a whole because that's where the earnings trends are, and they have more exposure to the kind of the secular growth. And that's the dominant theme of this bull market is still AI.
Kevin, you said tech, you said industrials, you said utilities. What do you like in each of those sectors?
I would say from the technology perspective, how about Taiwan Semiconductor? Largest dedicated chip foundry in the world, 60% market share, and they're developing chips now on U.S. soil in Phoenix, Arizona for companies like NVIDIA. Aerospace and defense, Northrop Grumman, the maker of the F-2 stealth bomber that actually carried those bunker-busting bombs that were used in the recent exercise over in Iran. And then in terms of power, I think of a company like NiSource. NiSource is a utility, pays a decent dividend, but they're one of the largest natural gas distributors in the country, distributing in states such as Pennsylvania and even Virginia. Virginia, which has become the Silicon Valley of data centers, critical to the AI revolution. So those are three areas I name it like.